The Aberdeen Global Asian Local Currency Short Duration Bond Fund is a fund that essentially is an Asian currency fund. Now, with any currency fund, you have to do something with the cash. And what we think is the most conservative thing to do with cash in an Asian currency fund is to invest it in short-dated Asian local currency government bonds. So when investors come into this fund, the principal risk they're taking is Asian currency risk. Asian currencies up or down against whatever is their base currency. In this fund, they're not taking any credit risk. They're taking very limited duration risk. And of course, they're not taking any equity risk. And what's very interesting about this fund is it's unique. No other fund manager has this offering. So if you have clients, or if you are a client who is positive on Asian currencies, but doesn't want to take equity risk, or duration risk, or credit risk, this is a very pure way to express that view. Now, in our investment process, we make interest rate forecasts and we make currency forecasts. So in this fund, the interest rate forecasts decide or drive the allocation to the different bond markets in the region, and the currency forecasts drive the currency exposure. In terms of the currencies we look at, it's the bond markets and currency markets of China and India, Hong Kong and Singapore, Philippines, Indonesia, Thailand, Malaysia, Taiwan and South Korea. We don't, in the fund, look at Japan, we don't look at New Zealand, we don't look at Australia. This is a pure Asian currency play. A very, very simple fund. The only thing that's in the fund are cash bonds and FX forwards. There are no derivatives, no leverage, no net shorts, no P notes, no structured products. And we keep a little bit of US dollar cash in the fund because that's the base currency of the fund, but that's all there is. It's a very old-fashioned, very simple bond fund, just bonds and FX forwards, and a very pure play on Asian currencies. The benchmark is really there just to be like a label on the tin, so that when you open the tin, you're not surprised what you're going to find inside. So, for example, a country like Hong Kong is over 20% of the index. Now, the Hong Kong dollar, for example, is pegged to the US dollar, and we don't like the US dollar. So even though Hong Kong is 20% of the index, we have less than 1% of the cash of the fund invested in Hong Kong dollar-denominated Hong Kong government bonds, and we have less than a 1% exposure to the Hong Kong dollar in the fund. A country like Taiwan has 7.6% weighting in the index. We don't have any Taiwanese bonds, and we have no exposure to the currency either. A country like South Korea, for example, which is about 15% of the index, has a fantastic bond market. It's probably the most liquid and best bond market in Asia. We're 10% overweight the Korean bond market. We have about a quarter of the fund invested in South Korean won-denominated South Korean government bonds. When you take a country like China, although the Chinese bond markets are closed essentially on the mainland, and the dim sum bond markets in Hong Kong are only just beginning to grow, we have a very large currency exposure to China. We're probably about 7% overweight the Chinese renminbi. We have about 27.5% of the fund today exposed to the Chinese renminbi. Now, why such a large position? Some people think that a large position is necessarily a risky position. Well, actually, from our point of view, the Chinese renminbi at the moment is one of the lowest risk countries in Asia, or currencies in Asia. And we think that the payoff by being long renminbi is sort of like the payoff from a call option. If we're right and Asian currencies rally, then the Chinese renminbi will be part of that rally and will make money. But if we face a 2008 Lehman moment again, we think there's a very good chance that the Chinese will do exactly what they did in 2008, and that is repeg to the US dollar. And if the dollar were to rally in such an environment as it did in 2008, then we think the renminbi would be one of the best performing Asian currencies because it would be pegged to the dollar. So we're absolutely, the benchmark is there, but it's an Aberdeen best ideas Asian local currency bond fund with a best ideas Asian currency overlay on top. I mean, I think that all the comments you make are very, very fair. I think in the world we live in today, it's a very difficult world for most investors. there is no risk-free asset globally anymore. And I wouldn't want to sit here and pretend that Asia is risk-free. Of course, there are risks. Top of the list would be inflation in the region, which is public enemy number one. And secondly is politics. I mean, we're about to go through a very significant political change of leadership in China, for example, which of course is one of the most important economies in the region. But at the end of the day, the Aberdeen approach is that the only way to invest money is to focus on quality and to try and buy quality at a sensible price. And it doesn't matter whether you're trying to buy equities or bonds or currencies. At the end of the day, quality matters. And when we look around the world today and we compare Asia to, for example, the developments in the West, whether it's in Europe or in the United States, from a bond investor's point of view, if you're looking at government bonds, all the quality today is in Asia. In terms of debt to GDP levels, broadly, Asia is solvent, and broadly, the West is not solvent. Now, from a currency point of view, and obviously this is a currency fund, we do have the view that over the medium term, Asian currencies are set to appreciate. And it's worth taking a moment just to explain why. The first reason is to help fight inflation. Inflation in Asia is partly due to higher commodity prices for food and energy. Commodities are priced in dollars. So if Asian governments let their currency go up against the dollar, that's going to be deflationary, or at least help fight inflationary pressures that are coming from that source. The second reason, though, that is more important is that Asia is switching gears away from export-led growth to domestic demand-led growth. Now, just as you wanted to have a weak currency to promote export-led growth, so you want a strong currency to promote domestic demand-led growth, because a strong currency will raise real incomes for citizens in Asia. Now, why is Asia switching gears? Well, first of all, there is a practical consideration. I mean, you cannot have export-led growth to an economy like the United States anymore, where the consumer is flat on his or her back. They literally cannot consume anymore. So every policymaker in Asia understands they have to switch gears from that practical point of view. Now, switching gears is not like a light switch that you can flick on or off. This is like a supertanker trying to do a U-turn in the middle of the Pacific Ocean. It's going to take time. But the other reason for switching gears towards domestic demand-led growth is because of what's happening domestically in the region. In Asia now, you have the scent of jasmine wafting over from the Middle East. I mean, I give the example of a country like India. 10 years ago in India, only 3 in every 1,000 people had access to a telephone. Today in India, there are 800 million mobile phone subscriptions in that country. It basically means that everyone in India, and many people in China and Indonesia and Thailand and Vietnam, etc., everyone now there is wired to the world. Everyone in Asia can now see the lifestyle that we all lead in the West, whether it's here in Milan or in London or in New York or any other major Western city. And guess what everyone in Asia is thinking? They're thinking that they want that lifestyle for themselves now. So the pressure on Asian governments to invest in infrastructure to make the lives of Asian people better is quite intense. And it doesn't matter whether it's a one-party state like China or a multi-party democracy like India. The pressure on all governments in the region is to make their citizens' lives better. So this idea that the savings of hard-working Asians are somehow going to be channeled into a central bank or a sovereign wealth fund or a national pension system to be lent at virtually zero interest rates to governments in the West that are basically bankrupt and printing money. I mean, even the ECB is printing money, which is something that Asians were told that they couldn't do in 1998. Lending money to governments that are printing money, to governments that are actively trying to devalue their currencies, is completely and utterly over. It's finished. Asian savings are increasingly staying at home. And this is going to be an incredibly important driver for Asian currencies over the medium term.